is running from point one towards the end of the day. We've got some fantastic presentations for you in this session, and we're rounding it out with a panel session, and we'll keep you up to date on that as we go. Right, let's get right into this. Alpha HPA, it's redefining the standard of aluminium purification to produce industry-shifting, sustainable, high-purity alumina products for application in synthetic sapphire crystal. Also in LEDs, electronics, optics, and lithium-ion battery manufacturing industries. And by combining their innovative technology and their commitment to being part of a more sustainable manufacturing industries, they are doing a really wonderful job at contributing to our future. So here to tell us more about the commercialization of what is a breakthrough technology is Alpha HPA's Managing Director. Would you please make welcome Rimas Karatas?
Great, thank you. Great, thank you very much, and thanks for the opportunity to present the very unique Alpha story today. I'll be talking about our business, which is based around a range of ultra-high purity aluminium materials, and also the context in which Alpha is commercialising those, particularly around the supply chains that we're working in and the sort of very positive sort of distortion of supply chains by a sort of range of geopolitics and government regulations. So I'll start with a photo of Alpha's first production facility up in Gladstone in Queensland, which is our stage 1 facility, which is now in production. And I'll hopefully describe to you the value proposition of Alpha as we roll out our project and our technology into a second stage, much larger scale production on the same site. So a quick intro into Alpha. We're not a mining business. We have a very unique purification technology that allows us to produce a very a sort of industry leading range of aluminium materials for high technology sectors. So we're very much an industrial tech business based around a key processing technology. Our commercialization vehicle is the HPA First project, as I mentioned, up in Gladstone, and we're doing a 2-stage rollout. So stage 1 is in production on the project site, and we're expanding stage 1 courtesy of a critical minerals grant from the Australian government. And stage 2, again on the same site, is a larger scale rollout of the same technology, which is currently finalising. Alpha's currently finalising FID for stage 2, and we're really pleased to note that we're really well supported by the Australian and Queensland government for stage 2, with a combined $66 million worth of grant monies ready for stage 2 on FID. So we're absolutely sort of delighted with the sort of degree of government support, the recognition of what we're doing and the criticality of our minerals in the supply chains that we're working in. In March 20, we released the DFS, which we reference at the bottom, that we're currently updating. But the March 20 DFS showed an incredibly robust business, around an average around 200 million Australian dollar free cash flow per annum. Now, as I mentioned, we're updating that. Those metrics we expect to be very much preserved, and we look forward to bringing that to the market extremely soon. So as we introduce the business, let me work through the disclaimers, and I really want to talk about Alpha's process because it underpins the business. There's some complexity here which I won't deal with so much, but what I really want to focus on is we take a very low cost raw material from smelters in Rio Tinto's facility in Gladstone, 2 kilometres away, and we use chemicals from our project partner and shareholder Orica, who are 50 metres away, and we combine those with our process technology to produce this ultra pure aluminium stream, and we're able to direct that into a range of ultra pure aluminium products. Principle of those is high purity alumina, HPA, which you'll hear about talking about, but our products are much wider than HPA. They include aluminium salts for cathodes. They include hydroxides for the CMP polishing business, and they include nitrates and sulfates, which are really key products for a full range of sort of high-tech industries. And we're really pleased to sort of note that we're already in production for our first at commercial scale, and we're producing all products at small scale, but expanding those rapidly. If you look across our product range, what I really want to focus here is this is a summary of our product range. So there's 5 sort of key product areas, but you can see at the bottom what sectors that do we service are all high-tech sectors, and they're all sectors where very much critical mineral aspect to them, and where supply chains are becoming really critically important. Lithium-ion batteries probably really well understood by the sort of generalist audience. LED lighting probably less understood, and I'll talk a bit more about LED lighting and how that supply chain is being disturbed at the moment, and semiconductors, which many of you will be aware of, particularly here in Southeast Asia, just what a critical industry it is, and just how supply chains are being reshaped in that sector, and where Alpha plays. So LED lighting I want to talk about first, just because it's, we all kind of take it for granted, but when we talk about decarbonisation, LED lighting is actually the most powerful decarbonising technology that's ever been implemented. It's already saved about 1.4 billion tonnes of CO2 just through lighting efficiency, and that's expected to double again over the next 5 years. So another billion plus tonnes of CO2. 5% of all electricity generated globally is commercial and residential lighting. To give you an idea, if LEDs had never been invented and implemented, that would be closer to 16%. So you can see what an incredible saving it's already produced, and it's now being disrupted again by the introduction of micro LEDs, which is a technology thematic inside LED lighting, which is reshaping this sector again. And I want to highlight the yellow box because this is how Alpha's materials are so critical to the LED sector. We produce high purity alumina is the direct feedstock for sapphire substrates, which almost every LED chip is built upon. Our material goes into LED phosphors, which down convert the light that you see with your eye, and increasingly our precursors are being used for micro LED phosphors. If you look at the LED as a chip, which is simply what it is, it's a light emitting semiconductor. Instead of built on silicon that you'd be familiar with, LEDs are built on sapphire glass substrates, and sapphire glass is directly grown from high purity alumina. And you can see on the right hand side, one of our key products is high purity alumina tablets, which get converted into monolithic single crystal sapphire glass, gets wafered down into LED substrates. And our materials also go directly into the phosphors, which go on top. We already have some two key customers in the phosphor space, Lumileds and Litec, both EU-based phosphor producers. We're qualified already with a Japanese producer of aluminium nitride, which is another phosphor material. And we recently announced a very significant transaction in the sapphire glass space that I'm going to talk a little bit more about. But this is why the LED market is particularly, it was already very exciting for the producers of alumina, as it's the base load end use. But the adoption of micro LEDs is set to double the entire sector. So everything and all the raw materials that feed into LEDs will be doubled by the adoption of micro LEDs. Bloomberg reported in January that Apple are moving to micro LED displays, with others expected to follow. And this is a dramatic development for the sector. That means that everybody supplying the sector is set to benefit, and in particular, sapphire glass production. And sapphire glass is the conversion of densified high purity alumina that Alpha already manufacture into sapphire glass. And this is an example of a sapphire glass bull, as it's referred to in the sector, and that'll get wafered down and LED chips were built upon it. We did a transaction just recently, only 2 weeks ago, to work with a European sapphire glass manufacturer, Ebna Faintech, and we'll be working with them rolling out up to 100 sapphire growth units in the hopefully in the Gladstone district, as a direct complement to Alpha's existing business. And this is a really exciting development for us because, as I mentioned, it's a really key downstream movement from Alpha. So we're already taking a raw material, converting it in HPA and capturing a downstream value uplift. And by converting that HPA directly into sapphire glass and participating in that downstream step, the actual value of the material goes up around 20x, but the net revenue movement is around 10x. So it's a really significant value add for Alpha's business. And This is very much related to geopolitics. It sits behind the transaction, Ebna Faintech, and their own customers are very concerned about the sapphire glass sector because it's so Russia dominated. The largest producer in the world is a monocrystal based in Russia, part owned by the government, Russian government. So it's been sanctioned, and this market is scrambling to backfill a reliable tier 1 jurisdictional supply of sapphire glass, and Alpha is participating directly in that effort, and with a really high quality tier 1 partner in Ebna Faintech. So a really important step, and very much enabled by the Australian government support for our business. So if there's ever a case study of governments and critical minerals funding stepping in, supporting a business and accelerating commercial outcomes, we think this is a fantastic case study, and we're incredibly bullish about this step for Alpha's materials. So stay tuned as we scale up Alpha's business in this sector. E-mobility, probably, it's already a sector been well spoken about here and in this forum, so really well understood. Alumina plays a really key role in the lithium-ion battery cell, on the separators to manage thermal management inside the cell, but really importantly, its role in the cathode, high nickel cathode precursors as either coatings or dopants, and that's particularly the application that Alpha's working in. And we have, I think, now 4 global cathode OEMs that we're working with, supplying a mix of test products for either dopants or direct synthesis of high nickel cathode materials. Aluminium's not as headline as your nickel, as your lithium, cobalt or manganese materials. Is typically between 1% and 5% of the cathode, so it's much it's a smaller and not as headline grabbing, but it's critically important to high nickel cathode stability, and a reliable high purity supply from a tier 1 jurisdiction is one of our sort of key key offering in this space. So I sort of break this down in some more detail. I think in time, if you get the opportunity to come and talk to us in the booth, I'd love to sort of step through these applications in more detail, but principally some examples of our materials coating cathodes, coating lithium-ion battery separators, and coating the anode materials as well. So it's quite a varied and technically relatively complex application, but we have a range, I think, of nearly 12 counterparties that were in advanced stage qualification test work across separators, cathodes and anode materials. So a really important part of our business. And this is like a kind of a proxy for aluminium material demand. You would have seen sort of similar graphs for lithium, nickel, etc. But even when you're applying 1% to 5% aluminium sulfate in NCA or NCMA cell chemistries, it has a dramatic demand effect on forward demand for aluminium sulfate. So you can see this is a sort of 5x demand in 7 years for aluminium sulfate directly into cathode. Alpha expects to produce between 1,000 and 2,000 tonnes within a 500,000 tonne market. So we're very much a tiny piece of this market, very focused on the premium end use. But it's a really exciting sort of supply demand setup for Alpha's market entry. And when you look at who's using what chemistries, this is from the P3 group out of Germany, who some of you may know, who support the UBS battery materials research. Essentially everyone in that green box is using or will be using aluminium materials, either as a direct synthesis chemistry, salt, or as a dopant. So they're all in our either actively working with Alpha or on our target list. So we're a significant part of the cathode market, sort of, or our materials can go into the cathode market. And the other sector that's been, I think some of the early talkers spoke about the effect of the IRA and just how it is sort of reshoring and friendshoring materials supply to jurisdictions like Australia. The other sector that is being really heavily sort of influenced by government stimulus and government legislation is the semiconductors sector, and in particular the high-end silicon carbide based processing chips, which are very much the target of the CHIPS Act, the US CHIPS Act. And the reason why we sort of have begun to talk about this sector and it's become a really important part of Alpha's product development business is that we have, for the first time, actually received a lot of inbound calls around our materials being used in the polishing slurries. Polishing slurries for semiconductors is about 7% of the sector. So it's actually a relatively small part of an enormous sector, and therefore it's an enormous market on its own. And Alpha's nanomaterials, nano HPAs, are the key abrasive material that's being tested globally for CMP slurries. We will be incorporating nanomaterials in our final project configuration, and it's become a really important part of our business. But you know, the reshoring thematic really playing into Alpha's sweet spot here. The other sort of critical part of what we do is the carbon profile of how we operate. Because HPA is traditionally manufactured, or indeed all high purity aluminium materials are based around an aluminium metal feedstock, you inherit the carbon profile and the cost profile of an aluminium feedstock. Now, Alpha uses a chemical process. We use a readily available raw material that's very early in the aluminium supply chain. So as a result, we can reduce CO2 emissions by around 70%. And this is incredibly important and increasingly important for our customer target list and the groups that we're working with. So not only do we offer a premium product, but we offer it with essentially a CO2 reduction for free. Just a couple of photos to give you a sense of visualize the business. Here's our 3,500 square meter facility up in Gladstone. You can see the proximity to Orica and the ability for us to integrate with their processes. We bring process reagents in and return a byproduct. So we have a zero waste residue facility. In the background, you can see the source of our feedstock being Rio Yarwun. So it's a fabulous location up there in Gladstone, and we're very, very much leveraging existing industries. So I mentioned stage one is in production. We have well over 100 tonnes of our aluminium nitrate product that we will allocate into some contracts within the next month or two. So please keep an eye out for that. And we're also in the process of converting that material into our alumina products. And here's various photos of products going out the door from our stage one facility. In addition, I mentioned earlier, we had a critical minerals grant to expand stage one facility. So everything in pink here is our expansion project. This is running now. So we're an operating facility as well as a construction site. So it's extremely busy. By the end of this year, we'll be producing every product within our range at either production or commercial scale. So it's a really exciting development and wonderful to have critical minerals support. And when you look at how our business will scale, as I mentioned, we all on the same site, all owned by Alpha, all permitted. Stage two, a significant scale up, and now over $60 million of government support already for stage two, which is wonderful. We have a global market network. We have agents globally supporting small scale sales and all of our product development work. This is a really intense qualification process, sometimes takes up to 2.5 years. And we're 3.5 years into engaging with the market. And we're really excited about making some announcements shortly about key customers. Here are the customers and counterparties that we can announce publicly. Most of the test work, you'd appreciate, done under NDA. So once it's reached commercial outcome, we're able to bring that to the market. As the company sort of steadily built and expanded and commercialized its technology, we have, I think, developed a really strong test record of adding value to the business. We expect to continue to do that. And if you look at a 3-year sort of price chart, we have progressively expanded the value of the business, and we're really excited about particularly the next 3 months as we continue to do that. And I thought I'd finish with what was relatively recent news, which is the support of Orica as a major shareholder. Not only have they joined the register, but we're also working with them on a North American expansion project. And this is the reason why. This is the rollout of all of the battery sector capital projects in North America, and our project plans to be next to Orica right there in Alberta to support the North American sector. And this doesn't include the semiconductor rollout, which is a sort of an equivalent map. So please stay tuned, and thank you very much for the opportunity. We really look forward to delivering some really key value catalysts over the next few months. So thank you very much.
Thank you very much, Rimas. We're moving across to nickel now. And just under a year ago, Nickel Mines Limited changed their name to Nichols Industries Limited. And that pretty much reflected the company's transition from explorer and miner of nickel ore to a globally significant downstream processor of nickel metal. It's a pretty interesting story because they're rapidly growing towards their goal of becoming one of the world's largest nickel producers. They've got a diversified suite of nickel products. They've got some of the world's largest or lowest carbon intensity. They've also got a really low OPEX. And this fellow here is going to fill us in on that. Would you please make welcome the MD and very keen explorer, Justin Werner.
Thank you very much. Thank you, everyone. Thank you, Tribeca, for hosting us at the conference today. Just to sort of set the background for Nickel Industries and where we operate, we've been in Indonesia for 15 years. Indonesia last year produced 50% of the world's nickel output. So we like to think of Indonesia as to what the Middle East is to oil, and the Pilbara to iron ore. And that growth in nickel production and nickel processing in Indonesia is only set to continue. If you have a look at the chart there on the bottom right, all along the value chain, you can see the significant tier one global names, Ford, Tesla, Volkswagen, Cattle, BASF. And these investments are actual investments that are now currently breaking ground. So Indonesia, over the past couple of years or since the implementation of the ore ban, actual and committed investment is totaling up towards US$70 billion. So significant investment all along that value chain. And in fact, we had Mitsubishi and Hyundai breaking ground on the first electric vehicle plant in Indonesia. We operate out of two of the world's largest nickel production centres. The one on the left, Indonesia Morowali Industrial Park. That's the world's largest fully vertically integrated stainless steel park, capacity of in excess of 3 million tonnes of stainless steel per annum. And we also operate out of Indonesia Weda Bay Industrial Park. It's basically really a carbon copy of IMIP, other than at this point in time, it doesn't have any stainless steel capacity. These parks combined employ in excess of 100,000 local Indonesian workers. And at IMIP, they've just recently commissioned two successful high pressure acid leach plants, which I'll talk about a little later on in the presentation. Just to give you an overview of our production facilities, you can see across the top there where they're located, so IMIP and IWIP. Our ownership is 80% across all of our assets, and we are moving to 80% on the Oracle nickel RKEF lines. And then you can see at the very end there, the Huayu Nickel Cobalt, which is the high pressure acid leach plant. We've just announced the acquisition of 10% of that HPAL plant. And then the future HPAL, which we've announced, comes with a CapEx guarantee, which will produce not just MHP, but also go further down the value chain to produce sulfate and cathode. You can see the different products there on the second column from the bottom there. So we produce MAT, NPI, and MHP. So one of the only diversified nickel producers as well. Most nickel miners and producers produce one product. We produce a suite of products which gives us access to and gives us exposure to all the different elements of the nickel market and the different pricing dynamics. You can also see at the very bottom there the production profile from each of our operations. That's in pure nickel tonnes. That is still growing and is set to continue to expand. And as I said, we will be in the coming years a top 10, probably a top 5 global nickel producer. Just a very simplistic business model. We were previously nickel mines, and that was what we went to Indonesia to do. And we started up a world-class nickel mine, but we've since transitioned and gone further downstream into the processing side of the business. And that is where we see majority of our revenue being generated. If you look at the top left there in the blue shaded box, the Hengjaya mine, we did 3.5 million tons of ore last year. EBITDA from those operations was US 54 million. You come down and look at our 12 RKEF lines, EBITDA last year, US 299 million. So you can see where the majority of that value capture is coming from. It's also very important to note that our processing operations are not reliant on the ore from our mine. We are one of 80 suppliers into the industrial parks, so two mutually exclusive businesses. And that brings with it obviously a lot of flexibility, but also means that unlike a typical mining operation, we're not dealing with geological complexity or metallurgical issues. We recently executed an electric vehicle battery supply chain strategic framework agreement. There's a number of elements to that agreement, which I'll quickly talk through. The first is acquisition of 10% of the Huayu nickel cobalt HPAL plant. This particular plant has the world record for the fastest build. It was built in a little over 18 months during the COVID pandemic, has the world's lowest OPEX and lowest carbon intensity. So it's become a real showpiece for what a successful HPAL plant should look like. We also have paid an option for a brand new HPAL plant, which effectively will be a replica of HNC. Other than I mentioned, it will come with that ability to produce more than just mixed hydroxide precipitate. It will go further down the value chain and also produce nickel cathode and nickel sulfate, which is then can then go immediately into precursor production. That option and that ENC is what we call it, Excelsior HPAL plant, comes with a capex guarantee, a nameplate guarantee, and a timeframe guarantee, which is extremely valuable. And I'll touch on that a little bit later on. All of our processing plants have come with that capex guarantee, nameplate guarantee, and operational guarantee. We've also paid an option for a matte converter, which will take low-grade nickel matte produced from our RKEF lines, upgrade it to high-grade nickel matte, which we can then sell into the Class 1 nickel market. And then finally, as I mentioned, we're just increasing our ownership in Oracle Nickel, which is now commissioning from 70% to 80%, and that just provides consistency across all of our operations in terms of 80% ownership. This is an aerial view of the HNC HPAL plant. As I mentioned, world's fastest build, fastest ramp up, lowest carbon intensity of around 7 tons of carbon per ton of nickel. How it's able to achieve such a low carbon intensity is it has the world's largest sulfuric acid plant. And in the production of sulfuric acid, a significant amount of heat's generated, which is then converted into power. Also, as I mentioned, lowest OPEX, so generating margins of around $10,000 a tonne, and I'll talk around the margins of the various products a little bit later on. But as I said, this is really the next generation of high pressure acid leach plants, and it's finally delivering what HPAL has sort of promised to deliver for the last 40 or 50 years, but has continually fallen short of delivering. I should also add that HNC has a plan to be net zero by 2030. I mentioned we paid an option for an additional HPAL plant, a replica of HNC that we just looked at, built by the same team. It will have 67,000 tonnes of nickel capacity. Again, comes with a capex guarantee, and I can't overstate how important that is. The cost is the full cost, so a lot of numbers recently have been announced in the market, particularly in Indonesia, for new HPAL plants. A lot of those numbers are just purely EPC costs, and they don't include a lot of the auxiliary facilities such as tailings areas, sulfuric acid plants, etc. And again, not just a capex guarantee, but a nameplate guarantee. On a capital intensity basis, you can see where that sits. These are Indonesian HPAL projects recently announced, the Huayu Ford Vale project, and also the BASF Eramet, and these are Australian projects and other countries. So you can see from a capital intensity basis, it's also world's lowest capital intensity. I've spoken about the power of that CapEx guarantee. These are CapEx blowouts across the battery and mining space. And you can see that the quantum of the blowouts is significant, you know, sometimes in excess of 200%. You know, there was a mining company that was recently acquired. The original guidance to develop the mine was about Australian 299 million. That's now blown out to in excess of Australian 800 million. And unfortunately, that's consistently happening across the whole industry. We are shielded from that. And again, it's lowest CapEx, but we don't pay a cent more. And obviously that gives our equity and debt investors a significant amount of confidence in terms of knowing that when the investment is made, that the price is fixed. What does all this new nickel production do for us? This is where we sat last year, 22 on a 100% basis, over 70,000 tonnes of nickel. With the acquisition of the 10% and with the new HPAL plant, puts us up to 156,000 tonnes of nickel on an annualised basis, above Glencore, Sumitomo, groups that have been in the nickel business, BHP for, you know, in excess of 40 years. And we believe that with the relationship, that very strong relationship that we have with Tsingshan, who's our largest shareholder, that, you know, we can continue to grow this, particularly again, you know, in a way that it's about as risk-free as you're going to get in the processing business when your projects come with CapEx guarantees and nameplate guarantees. Importantly too, not only are we increasing our production, but you can see down here the mix of nickel that we produce. So historically, we've produced predominantly class 2 nickel, which can only be used in the stainless steel market and has a higher carbon intensity. We're now diversifying our business to where around 80% of our production will be class 1 nickel. It'll be a diversified mix of class 1 nickel, much lower carbon intensity, and it will also diversify our customer base. So it will allow us to sell that product into global tier 1 Western and Asian EV makers. I mentioned the nickel matte converter, and the reason that we're looking to invest in that is Tsingshan, again, through their innovation, is the only company that has been able to take an RKEF line that produces nickel pig iron, make a very simple conversion, and then to allow it to produce nickel matte, which is a class 1 product and has a very, very different pricing dynamic. You can see here, in terms of the EBITDA margins, these are two identical RKEF lines, RNI and HNI. RNI is still producing NPI, and the margins last quarter were 2,625. HNI has been converted to the production of nickel matte. Margins last quarter were 5,950. So you can see, you know, that margin differential and that move into class 1 nickel. You may recall I mentioned that HPAL and MHP seeing margins of around $10,000 a tonne. So not only are we diversifying, we're also looking to potentially significantly increase the margins that we generate. You might look at that and say, well, why don't you convert all of your RKEF lines to the production of nickel matte? The limiting factor is that the RKEF lines can only produce a low-grade nickel matte. It does then have to go through a converter, and that is why we've paid an option to build a 50,000 tonne capacity converter. CapEx is very minimal, US 110 million. You can see with the margin differential of around $3,000 a tonne on a 50,000 tonne matte converter project, the payback would be extremely quick. This is really just a simple summary of how that nickel matte production works. So saprolite ore goes into the RKEF, produces a low-grade matte of around 25% nickel by content, goes through the converter to produce a high-grade nickel matte, and then that is then further refined into nickel sulfate and into the EV battery supply chain. With that, we'll just finish up on. I mentioned here our current production for last year. This growth here is all paid for and locked in. So we are currently moving to in excess of 113,000. With the Excelsior HPAL project, that takes us to 155,000. This is the breakdown of class 1 nickel and class 2. So you can see we're moving towards a much larger percentage of class 1. And then if you look at this, this is a doubling of our nickel production. And so if you look last year at our FY22 operating profit, US 258 million, group EBITDA of US 339 million. That is in the process of doubling. Again, it's all paid for. And we foresee the company in the next 2 to 3 years of generating EBITDA in excess of US 1 billion. And finally, we benefit from significant tax holidays. So our operations have tax holidays anywhere from 7 years to 15 years. And we have very, very low sustaining CapEx. So our EBITDA to free cash flow conversion sits at around 99%, which obviously that's not the profile of a mining company. Thank you, everyone.
Justin, I have to admit that I actually rushed you at the end there. So is there any other points that you wanted to clarify? I had a small problem with my timer and I would hate to eat into your opportunity to communicate everything fully with people.
No, look, the only final 2 points in the presentation was our Hengjaya mine. I haven't touched on that much, but that's a very important asset, 3.7 million tonnes of contained nickel metal currently. So that puts it up amongst the top 10 global nickel resources. You can see it on the chart here. That's where we sit in terms of known global nickel resources. And finally, again, on our Hengjaya mine, we were awarded a green PROPER rating from the Indonesian Environmental Authority, one of only 2 nickel mines in the whole of Indonesia to have received that rating, and a reflection of, you know, the very responsible and sustainable mining that we've undertaken. And so we've had representatives from Tesla to the German Chamber of Commerce come and visit our mine as they become more interested in upstream and source of the ore. So it's very important strategic asset. Strong cash generation will continue to grow, and I think most importantly is you know, one of the best run and acknowledged as one of the most environmentally sustainable mines in Indonesia. So final 2 points. Thank you.
Thank you. And one which your MC should not have cut you off from telling everyone. My apologies.
That's
Thank
right.
you. Would you
Thank
please thank Justin, everyone? You know, you get to a point you think, I know he's missed something and I've cut him off. So I want to make sure that that came across. So all on your MC then. Let's see how I go successfully with our next one. We're going Global Lithium. Can I invite Ron Mitchell up to join us on the stage? Hello, Ron. Now, Global Lithium is an established lithium exploration company. They have a focus on 2 highly prospective 100% owned Western Australian projects. They've got the Manna Lithium Project, which is in the Goldfields, and the Marble Bar Lithium Project, which is up in the Pilbara region. Ron, far away. You've got 20 minutes and I promise to get the timer on correctly.
Yeah, thanks, Chrissy. Thanks to Stuart Jackson putting on a really excellent event, an inaugural event here in Singapore. And it's a great pleasure to be part of this and bringing our story to the Singaporean investors for the first time. I think we've got an incredible story to be delivering and unfolding throughout the course of this year and into next. And one thing I will say, just echoing some of the other speakers talking about the energy transition, and we're embarking on that, it's still very early days. And that's really testament. The previous speaker talking about the role Indonesia is playing, and like consider, you know, a number of the meetings we've had from government delegations into Western Australia on a global basis from Japan, Korea, Europe, Indonesia, even the US, and trying to understand the role companies like ours can play in terms of bringing the next wave of projects to market. So with that, Global Lithium Resources, we have 2 projects. We're looking to fast track these projects, and I'll talk about the projects in detail throughout this presentation. But importantly, having great assets in the ground is one thing, and having a really, really strong, experienced team to be able to unlock the value of those assets is really the second piece. And that's where I think we're quite different. We have 2 assets that are in advanced stages of a combination of advanced exploration and development. And that's really where the upside comes with us as a company in terms of continual growth, building out our resource. And of course, that will be reflected in our share price going forward. Standard disclaimer, please encourage you to read it at your leisure. So again, the value proposition for us as a company, we've got a wonderful starting position in terms of our resource, 50 million tonnes across both projects located here in Western Australia. And this gives us really wonderful development optionality. They are the two best types of raw material to be producing downstream lithium chemicals for the electric vehicle battery industry. These are both spodumene outcropping resources. And spodumene, and this isn't anecdotal, this is real-time feedback from the industry. Spodumene does concentrate to produce a wonderful, consistent, high quality raw material for the electric vehicle battery industry. And ultimately, this is something the car makers are really looking for. You know, it's one thing producing product on a consistent basis, but another thing entirely to be able to do it batch to batch to batch to batch. And that's where the liability comes in. And this is what makes contracting in this industry really, really challenging, because it is still evolving. And this is where we have a lot of experience. I've personally been doing contracts, offtake agreements in the space for the best part of 12 years. Both of our resources are JORC compliant. So lithium JORC compliance is not an easy road. We've been and have developed our two projects, two of only 14 JORC compliant lithium resources in Australia. I think that's really meaningful. And we own these two assets outright. If you think about, a lot of the other resources are managed under joint ventures. So there's clearly an equity split in terms of ownership of those resources. And this puts us in an incredible position in terms of continuing to grow out these resources throughout the course of this year and next. We do operate in the world's best mining jurisdiction. The Fraser Institute last year voted Western Australia as the best mining jurisdiction on the planet for investment. And even within Western Australia, our two projects are located in incredible mining jurisdictions in their own right. So the first, our Marble Bar project in the Pilbara, home for obviously iron ore, but also there's two existing high quality lithium projects adjacent to our asset in Marble Bar. And secondly, as Christina mentioned, being a Kalgoorlie girl, our second project, the Mana Lithium project's located about 100 kilometres east of Kalgoorlie. So wonderful, wonderful places to be developing mines, very strong rule of law, a very good engagement with local communities, and most importantly, fantastic infrastructure and all of the relevant disciplines to be able to bring these projects to market. We do have two, excellent strategic investors on our register, taking around 20%. One is a downstream company based in China, Suzhou TANA, which is a controlling shareholder of a Yibin Li, a company that's just done quite a major deal with Ford Motor Group. They have around 110,000 tonnes of downstream lithium hydroxide capacity in China. And the other partner, Mineral Resources, and again, Mineral Resources has been a wonderful partner, a pioneer really in hard rock development in Western Australia, and they currently own two projects under joint ventures also in Western Australia. Importantly, 70% of our total offtake remains uncontracted. We really view our offtake position as a weapon. It's important because offtake, as it's traditionally been undertaken, is dead in the water as it relates to these high quality assets that we're looking to proceed with. So what you can expect to see in terms of offtake going forward is counterparties taking a real partnership position with the company. And by that, I mean, significant capital prepays and even equity subscription in the company. And that will continue to evolve throughout the course of this year. We do have a lot of lithium experience within the team. I've been in the sector 13 years working for, big lithium miners, and similarly, our geological experience of our geo team's got more than 80 years of lithium experience. Most of our geos have handled all of the lithium that's been discovered so far in Western Australia. But we do have a really strong broader management team as well. I think that's key, as I said earlier, unlocking the value of these assets going forward. There's three really core pillars to our company, and it's very much a culture, high performance driven company culture, exploration, and that's where our upside's coming. Project development, we've got a real gun project metallurgist with a PhD who's leading our project studies going forward, and he's got a fantastic in-house team working under him. And the third is approvals. And approvals is a critical path for every project in the mining industry, and we've got a really formidable approvals team. So just a quick snapshot of the company. We're a young company. We've only been listed on the ASX since May of last year. So we're coming up on May of 21. So coming up on our 2-year anniversary. We've got, quite a tight register at the moment. As I said, a couple of strategics taking around 20%, a couple of high net worth individuals, one of whom is in the room today, taking around 12%, and then board and management with reasonable skin in the game, about 4.5%. The balance is a combination of retail and institutional. So we are looking to roadshow quite significantly throughout the course of this year, really taking our story offshore to global investors for the first time. We think we've got a really compelling story that will resonate really well. Market cap sitting around 360 million, 257 million shares on issue. Importantly, we're well capitalised. We're really fully funded all the way through to final investment decision on our project. And there's a number of brokers covering the stock, as you can see on the bottom. We are in the world's best mining jurisdiction. Iron Ore has created this Team Western Australia brand. It's not just in Western Australia, the incredible experience and talent pool we have. I think it's well recognised by our global partners. And Western Australia has incredible trading partnerships with Japan, Korea, China, Europe, and of course the US. And this is where the value is for our companies. And Iron Ore has really paved the way for that by building out this incredible infrastructure, port, rail, road. And the mining industry, the lithium mining industry, has a great opportunity to leverage off the back of that incredible infrastructure. And this is where Western Australia is peerless on a global basis. Not only do we have incredible assets, we own 2 of those incredible assets, but it's all the softer disciplines around the technical capability, logistics capability, infrastructure, legal, commercial, technical. Just about everyone you meet in Western Australia who's involved in the mining industry is very familiar with lithium, and this is quite unique to our jurisdiction on a global basis. And this is where I think personally a lot of other nations are going to struggle, because they just don't have this ecosystem of expertise that we have. A lot's been talked about pricing. Spodumene pricing's holding up incredibly well. Current pricing as of only a handful of days ago was around $4,500 to $5,500 US a tonne. A lot of the talk about, some of the oversupply in the China jurisdiction specifically is on the back of some inferior domestically sourced lithium carbonate units, which are non-preferred in the electric vehicle battery industry. Happy to talk more about pricing post-presentation. Please come along to the booth and I'll share my views. Lithium has been in the headlines quite significantly recently. There's been a lot of investment into Western Australia by offshore entities. And I think the bid that came in last week from Albemarle on Liontown is probably case in point. You've got the world's biggest lithium company, US domiciled, who has made a play for an Australian explorer, a developer, and a hard rock developer. I think that sends a really powerful message. But not just Albemarle. I mean, SQM is very active in the West Australian space now, and we're seeing through the discussions we're having with downstream partners, there's just incredible interest. And again, this industry is only just getting started. So let's have a bit of a deep dive in one of our projects, our first project, 100% owned. As I said, this is an outcropping spodumene-bearing pegmatite. We've got an existing mineral resource here of close to 33 million tonnes, which is world-class in scale. We think it will continue to build out throughout the course of this year. We've got a very significant exploration campaign, which has just kicked off, 35,000 metre campaign, which puts it one of the largest campaigns in the lithium sector. And we think we're going to add some very serious resource tonnes to this project throughout the course of this year. But we're not waiting. We're moving. We're moving directly into development. We've just completed a scoping study, which suggests really strong project economics. It's given the board enough confidence for us to progress directly to a definitive feasibility study, which is now underway. The infrastructure piece, again, incredible infrastructure here. We're not far, only a handful of hours from the nearest port, which has available infrastructure, berthing infrastructure. And we're very close to Kalgoorlie. And it's only a 1 hour flight from Perth. So this is really attractive in terms of talent acquisition, but also retention. 1 hour flight from Perth plus a 1 hour transit to site, compared to other parts of the world where, you might have a mining asset that's effectively stranded because it's just so far from anywhere. Let's look at the resource. For those who aren't geos in the room, and I'm not one of those, this is a world-class asset, as I mentioned. The resource itself, more than 50% of the total resource is in indicated position. Our geo team has just discovered through the assays on some recent drilling at the back end of last year that didn't come into our resource model, quite a significant extension to this particular asset. It's faulted up to the northeast. We've had some of the highest grade intercepts and also the largest width. So this is going to be the focus of our exploration campaign throughout the course of this year. And this is where we're going to add some serious tons to this particular project. You're likely to see a second pit. The original scope, the scoping study has just been completed, suggests a single pit. We're likely to have a second pit to the northeast as well. So we're thrilled with this recent discovery, and certainly our geos are incredibly excited to get on country and continue building out and developing this resource. Just taking a look at the scoping study results. Now, I'd just like to point out, as a company, we only acquired this asset under a joint venture in December of 2021. We then delivered a maiden inferred mineral resource of close to 10 million tonnes in February of last year. We then embarked on a 50,000 metre exploration campaign that developed or delivered a 230% increase to the resource, and then completed a scoping study in February. To have done all of that in a 12-month period is really testimony to the team. Incredibly proud. And this is just the start for us. I mean, this scoping study underpins and gives the board of directors confidence to move forward with DFS, but certainly the metrics on this page are going to change, and we think change for the better. There's some incredible work we're doing around ore sorting trials, which will continue to increase the head grade, build out the resource, extend the life of mine, and increase the throughput. But these results in their own right are compelling. It is a scalable project, a 2 million tonne run of mine, delivering around 220,000 tonnes of concentrate. And again, I talked about the current spodumene concentrate pricing of 4.5 to 5,200. You can do the math on that. This is a really standalone, incredible project. Competitive OPEX and CAPEX. Importantly, the CAPEX was based on a Q1 2023 estimate by a really experienced outfit who have got a lot of experience in lithium. And again, having 100% ownership of the asset puts us in a fantastic position taking the project forward. So we are underway in the DFS. So we've got some of our geos here holding some of our stunning core. This is an open pit mine, and it is a spodumene bearing pegmatite with very low gangue minerals. So from a processing perspective, we're very confident this is going to clean up and produce a really wonderful concentrate. And in fact, some of the feedback from potential downstream partners in terms of processing, looking at our core, they're thrilled with the quality of it. So the feasibility study will roll out throughout the course of this year on the back of a very extensive metallurgical test program. And we're looking to make a final investment decision as a board next year. So yeah, there's a lot of work ahead of us. Of course, our environmental and heritage work activities are also underway. So there's a number of multiple work streams ongoing with regards to this project. Project number 2, again, Global Lithium is one of a few companies that has a diversified asset position. This project's located up in Marble Bay. You can see our tenemency package on the right here. It's very close to the Pilbara Minerals mine, and also the Mineral Resources Albemarle joint venture, the Wodgina mine, very similar geology. We have an 18 million tonne resource here at 1%. This is a very large land package, and this is where, again, there's quite significant upside ahead of us with regards to this year's exploration campaign. It's highly prospective ground. It is, again, as I said, an outcropping spodumene bearing pegmatite. We've got lithium mineralisation over a 15-kilometre strike. So our geos have targeted some incredible targets for this year, and we'll look to get on country very shortly, as soon as it cools down a little bit in Marble Bar. It's about 42 degrees at the moment. So the next month or two, we'll have the team on site. So again, this probably just portrays the size of this asset. The green tenement boundary on the right shows you the scale of the land package. It is significant. The Goldilocks zone in yellow there really, from a modelling perspective, identifies areas of prospectivity. And you can see there around the Archer deposit, which is where we've been drilling throughout the course of last year. We've only really explored a very small portion of this particular land package. So this is our sleeper project, if you like. We're really confident 12 months from now we'll be in a position to push the development button with regards to this project as well. So very lucky to be leading a company with 2 highly prospective projects, which are going to really make a difference to this energy transition future. So finishing off, I'm ahead of schedule, I think for the first time ever, Chrissy. So the key milestones for us this year, as I said, there's a lot going on. We're a busy company. It's a high performance culture. There's no micromanagement in our team. We just employ great people to do a great job. It's as simple as that. Exploration across both projects will run through to the end of this year. The DFS, as I mentioned, for Manna is ongoing. We're looking to complete that in Q4. We are looking to have an ore reserve out in Q3 as well. The metallurgical test work is ongoing. That work stream's commenced. We are using Wave International. They've got more than 100 years of lithium processing experience, and they're a local outfit as well in Perth. Very experienced, and they've given us their A team for our project because they're big believers that this will be a mine of the future. We're also announcing for the first time in this presentation, our aspirations to look at direct shipping ore, some opportunities there. We've got partners in China. We are seeing a technical delegation shortly to investigate those opportunities, to drill them out further. As I said, we have provided core, so there is a near-term DSO opportunity that could generate cash flow for us as soon as our mining lease is approved and granted, which we anticipate could be as early as the end of this year or early next year. And downstream, we think there's wonderful opportunities. We heard our resources minister speak earlier. We think there's some incredible opportunities around producing downstream lithium chemicals as well, and we're very, very well positioned. The other role or other hat I wear when I'm not the MD of Global Lithium is I'm also chairing the current London Metal Exchange Lithium and Cobalt Committee. So I'm getting some really fascinating insights into the downstream nature of those industries on a global basis. And I think, as Joe mentioned earlier, if you control the rock, you control your destiny. And we're big believers in that. So I think we've got some great opportunities there. We've got resource upgrades that have come to market. The approvals process is ongoing. As I mentioned, we've got a really, really strong approvals team. So that all segues to a FID, all going well about the middle of next year. And then construction, commissioning, start of production is probably an 18 to 24 month journey. So first concentrate production in market 26. If we were to go down the DSO route, we could have tons in market as early as next year. So I always like to finish on our just the strategy, which makes us unique. We've got a scalable resource, growing, huge upside across both assets. We're growth focused, and we've got great development optionality. We've got a value accretive story, not just to our investors, but our shareholders and the company and the team. We're all highly motivated. The DSO and downstream lithium chemical study scheduled this year, I think will bring some incredible upside as well to the company. We're really strategically positioned. We've got wonderful relationships globally. I haven't really talked too much around the downstream piece, but we are in discussions with some tier one counterparties that are offering some really, really wonderful options for the company from a partnering perspective. So my last slide is our purpose, our values. We live and breathe these on a daily basis. We've got an incredibly motivated team, and our key mandate really is owning it. Everyone in our business is accountable. And I think that's really important. So with that, I will leave you. Thank you for your attention and hope you enjoy the rest of the day.
Yes, Mr. Mitchell. Hey, how did you get to be the chair of London's Global Lithium, Cobalt and all the rest of it? How did your boy from here get over there and do that?
Yeah, I've been in the industry a long time. So when the LME first looked to bring in this cash settle futures contract for lithium hydroxide, they did some marketing, and I was at a lot of these conferences on a global basis. I met the LME team, developed a good relationship with them, and they thought, I guess with my experience, both on the upstream and downstream, I'd be a good fit. So that's worked out well.
Well done. Congratulations to you. It's a great title, great role. And what Ron was saying about Kalgoorlie is true. Such a fantastic place to live and to work. If you ever have the chance to go out there and investigate it further, one of my roles is as a TV producer with the Nine Network in Australia. And we were out at Hoover House, and you all know Hoover, one of the presidents of America. He used to be a mining engineer out in the goldfields. There's some really interesting history out there. We're going to move to the northwest of Western Australia, and we're going to go to a little place which is, if you can picture the northwest of Western Australia, half an hour's drive inland from the mining port of Karratha, and also half an hour's drive inland from the best fish and chip shop in Western Australia, Point Sampson, is the Andover Nickel Project. Well, it's been called the Andover Nickel Project for a while. It was identified by one of WA's most iconic geologists, a fellow by the name of Mark Creasy, and it was secured by Azure 3 years ago, Tony, is that right? So the project has been ticking over very nicely. Then it got a little bit bigger, and in September last year, you kicked a pegmatite or two, didn't you? And then another pegmatite and another pegmatite. Before long, they knew that they had that attracted one of the interest of one of the biggest lithium producers in the world. So it's now called at the gate the Andover Battery Metals Project. So what does it mean for Azure? What does it mean for us as potential investors? Is it in fact the next big thing? Would you please make welcome Tony Rivera?
Thank you. Thanks, Chrissy. You've just stolen some of my highlights there. I'll have to think up some new ones. And thank you very much, ladies and gentlemen, for the opportunity to tell you about the Azure Minerals story. As Chrissy just mentioned, it was about 3 years ago that we acquired an interest in the Andover project from Mark Creasy, who is a legendary prospector and highly successful operator in Western Australia. And initially it was the Andover nickel project. We were exploring for nickel, copper, cobalt sulfide mineralisation. We had great success. We identified 2 deposits, which are now have mineral resources ascribed to them, and also underway, or development studies are underway on those 2. But more recently, we identified the potential for and the actuality of there being lithium-rich pegmatites on the same property. So it's certainly expanded our focus. Usual disclaimer and statements, which can be found on our website on the various announcements. It's very important to acknowledge the traditional owners of the land on which we operate, the Ngarluma people. This is their land. They are the traditional owners and custodians there. We could not operate there without their approval and their blessing. And so we have developed over the last 3 years a very close working relationship with them. It's a very vitally important for the future of the company and of the project that we maintain that excellent relationship. And expanding out a bit from local community relations to the greater ESG side of things, so environmental and the social license to operate, etc. We believe very strongly that we have to operate to the very highest standards possible. And obviously being in Australia, those standards are already quite high, but we aim to meet and exceed those to the best of our ability. Now, corporately, the company's got about 390 million shares on issue. When I designed this particular slide, share price was about 30 cents, so the market cap was 130 million. Well, we put out an announcement this morning of some more intersections of spodumene-rich pegmatites, and the share price has jumped by about another 15%. So we're sitting up around $150 million market cap at the moment, with $23 million in cash and no debt. So the company's in a very secure position financially. We have recently welcomed SQM onto our register. SQM are one of the 2 largest lithium producers in the world. They're a Chilean company. Mostly brines is the source of their lithium. However, they are also in joint venture with Wesfarmers in Western Australia, building the Mount Holland mining and concentrating facility and a lithium refinery near Perth as well. So to have one of the 2 largest lithium producers on our register and showing us that support is a huge endorsement for the lithium potential of the Andover project. And the Andover project, I just briefly mentioned, is still a joint venture with Mark Creasy. We own 60% of the project, and Mark Creasy owns the other 40%. So the prospects that we're looking at, or the elements we're looking for: nickel, copper and cobalt, which has been ongoing for about 3 years, and also lithium. So Andover is located in the northwest part of Western Australia. It's a very infrastructure-rich area. To our south, we've got Rio Tinto's iron ore mines, and to the north, we've got their port facilities, and offshore there is oil, gas and LNG for Woodside and Chevron as well. So there's a very large amount of infrastructure in the area. So we have identified nickel, copper, cobalt sulfide mineralisation. We have 2 resources to get there, which total over 6 million tonnes of resources at about 1.5% nickel equivalent for nearly 100,000 tonnes of nickel plus copper plus cobalt. Plus we also have the new highly prospective lithium-rich pegmatites. So as I mentioned, the logistical area, from the logistical side, is that this is a really well-located project. On that image there, you can see outlined in blue is the 108 square kilometre project that we have, the Andover project. So you fly Perth to Karratha, that's 2 hours, and there's a half-hour drive along the Northwest Coastal Highway, which takes you directly into our project area. There are other roads and tracks that crisscross the project as well. There's high voltage power lines there, there's gas pipelines, potable water supply, mobile phone coverage everywhere throughout the project area. And Karatha's got 35 to 40,000 people who live there. So from a mining and exploration support centre, you couldn't get a better located project. And the other great thing about this project is that the rocks all stick out of the ground. There's no soil covering there, so everything you see on the ground is the original rocks that are there. And so it's traditional boots on the ground exploration with our geologists walking across the ground, mapping and sampling as they go, and identifying really good looking rocks at surface. For example, there's copper rich mineralization shown in the bottom left hand image there, the bottom right hand high grade nickel gossans sticking out of the ground. And the upper image is the high-grade lithium-rich pegmatites that we've identified as well. So just traditional exploration is identifying these targets, and that's always followed up with drilling. So we move into the lithium side of things. There's the project area, 108 square kilometres. We've identified over 700 outcropping pegmatites throughout that eastern and central part. They're shown there as those red shapes on the image. And of all of those pegmatites that we've identified in that pegmatite swarm or that field, all of them are located within our property. That this pegmatite swarm does not appear to go outside of our project boundary, which is quite remarkable. And this particular pegmatite swarm is over 9 kilometres long, 4 to 5 kilometres wide on the eastern end. And individual pegmatites we've observed over 1 kilometre long and maybe 100 metres or more wide at surface. And this is what they look like. It's basically rolling hills with a bit of spinifex grass covering it. So that makes the rocks really easily identifiable. The pale rocks are the pegmatites, the dark rocks are the host mafics and ultramafics. So very easy to identify, very easy to map and sample. And so that's what we've been doing a lot of. So nearly late last year, we had completed nearly 800 samples were collected. And of those 800 samples, you can see there the numbers that are very high grades, 2%, 3%, all the way up to nearly 5% lithium oxide in some of those samples. So very high grades at surface. And the challenge is, are those grades replicated in the drilling? Well, it appears that they may be so. So this was a drill hole we drilled very late last year. It's the first drill hole that we've actually intersected mineralized pegmatites up until the end of last year, hole 199, so a bit over 7 metres at 1.5% lithium oxide. The white mineral you can see in there is the spodumene, which is the preferred lithium rich mineral that we're looking for. And we heard from Ron earlier with Global Lithium, and their two projects have the same mineral species in theirs. So we're looking here at a little bit more drilling that carried out earlier this year, and we announced some visual intersections this morning. And so there's 4 drill holes drilled on there. There's pegmatites been intersected in all 4 of those holes. Visually, we have recognised spodumene in those pegmatites. And that's the information that we released to the ASX this morning. So some of those intersections are quite wide. They vary from 20 metres all the way up to over 50 metres wide. So very high, very wide widths of mineralisation of pegmatite in those drill holes. And you can see on the photograph on the left-hand side there, that's the spodumene-rich material in the pegmatite. So the white blades, the white crystals that you can see there is spodumene. So there appears to be a lot of it. So what we see going forward for the Andover, for the lithium part of the Andover project is a major drilling program. So 2 diamond drill rigs going by next week. Then we'll probably have 3 or 4 RC rigs in there before the middle of the year as well. The intention is to drill 40,000 metres of these pegmatites this year. And we'll also continue with the systematic surface sampling as well. Metallurgy test work will be underway as well, plus all of the other various studies that we need to advance the project. The strategic objective that's been set for the exploration department by Azure's board is that we would like to see before the end of this year the potential for Andover to host over 100 million tonnes of lithium resources. Now, if that is possible, and if we could confirm that that potential is there, which would then be followed up with resource announcements as well, if we could confirm that potential, that could quite likely make Andover one of the largest lithium resource projects in Western Australia. And then we've also got the nickel sulfide mineralisation as well. So this is located in the southwest corner of the project, bottom left hand of the project area that you can see there. 2 deposits, the Andover deposit and the Ridgeline deposit. one 4.5 million tonnes, the other one nearly 1.5 million tonnes. So 6 million tonnes of nickel resources, containing around about 100,000 tonnes of nickel plus copper plus cobalt. Once again, the board has set an objective here, or recognises a potential for being able to have multiple nickel mines that would be feeding a centralised processing facility. And so that's the premise on which we're operating and advancing the development studies. The two deposits we've identified, Andover and Ridgeline, located very close to each other. In fact, they're actually on the same mineralised structure. There's a small gap of about 200 metres in between them. But we're looking at having a co-development strategy. It would be an underground mining operation with a portal and then a decline that would access them, going to the north, turning left and right, and mining both of those two deposits simultaneously. As part of the studies that we've undertaken, there's been a lot of metallurgical test work done on the ore from both deposits. And what we do recognise now is that we can make a copper concentrate and we can make a nickel and cobalt concentrate. Both of those concentrates deliver good recoveries with very high grades of metals in there, and importantly, no deleterious elements. So this is we have sent the specs for these the specifications for these two concentrates to a number of the international metals traders, and there's certainly generated a lot of interest, and they have indicated that if we can produce these sorts of concentrates, they would be very willing to buy them. And then, of course, there's the upside. We've got a lot more targets that need to be drilled. These nickel targets will be tested as an ongoing basis throughout this year and probably into the future after that as well. So the scoping study that is nearing completion, we have basically finished all of the components that you can see on that list there. What we're currently doing is populating the financial model with all the operating costs and the capital costs. And we are hopeful of being able to announce the results of that scoping study either in late April or sometime in early May. It's still ongoing, and hopefully that'll be finished very shortly. So for the project, for the Andover project, it's a dual pathway project. We've both got the nickel and the lithium. Now, the nickel is more advanced. The nickel side of the project is more advanced because we've got two deposits that have been drilled. We've got resources for both of those. We've nearly finished the scoping study. Indications are 6 million tonnes of resources there is very attractive. Let's make it a little bit bigger. If we can get it up to 9 to 10 million tonnes, increasing the metal content by about 50% through additional exploration. So if we can get it up to 100,000 tonnes of nickel and 50,000 tonnes of copper, that is our aspirational target for something that would be very attractive to develop. So that's the objective that Exploration Department's been set for 2023 on the nickel side. But simultaneously with looking after the nickel, we'll also be exploring the lithium. Now, the lithium is behind the nickel in terms of a foot race. The two projects are quite different in their advancement. But the lithium exploration is actually a lot easier, or it's more straightforward, because the pegmatites that contain the lithium stick out of the ground, and visually you can see the spodumene, which contains the lithium, inside these outcrops. So when it comes to drilling and drill testing these, it's actually literally is just drive your drill rig up to those outcropping pegmatites and drill those holes. And so that's what we will be doing. What we also need to do to enable us to action all of that is that we need the environmental and heritage approvals. So that's a process that we're going through at the moment. We're able to drill in certain areas on the pegmatites because they have had prior approval. We are now hopeful of getting the full approvals for the rest of the project area completed within the next few weeks, in which case we'll have multiple drill rigs out there, basically just driving up to those outcropping pegmatites and drilling them. They are very visual. And because a lot of what we're doing is diamond drilling, you can actually see the spodumene minerals in the drill core. So it makes it easier and more straightforward in terms of planning and accelerating that exploration. So as I mentioned earlier, the objective of what we would like to see by the end of this year is the ability of this project to host over 100 million tonnes of mineral resources, of lithium resources. Now that is would put Andover into the world-class category if we can achieve that objective. So that's the Andover story. That's the focus for the company, to have nickel resources and potentially to have lithium resources on the same project within or close proximity to each other, and to have such an infrastructure rich area with all of those services that you need to run mines all within in our district is quite remarkable. And I'd have to say what's also quite remarkable is with all of this, these nickel occurrences and copper occurrences and now lithium occurrences sticking out of the ground, it is remarkable that they have never been looked at previously, considering they're only 5 kilometres south of the nearest town of Roebourne. So have that mineralisation sticking out of the ground, and no prospectors or old timers or modern explorers have been out there and identified that. So it just makes this whole Andover district incredibly prospective, and we are very confident that there's going to be a certain mining decisions will be able to be made for Andover in the near future. So I look forward to that happening, and I thank you all very much for your attendance and listening to the story.
Thank you very much, Tony. Now, before you leave the stage, there's going to be a little bit going on behind me. We have the first of our 3 panel sessions setting up. So I'm going to use that opportunity. Scott Clement from Tribeca is actually chairing this one. So he's going to be in charge and introduce you to all the panel operators. And this is a great one for investors for getting into this, this global transition energy area. Before you get off this stage, though, because I know it's been a big year for you, but I happen to get an inside running. Tony's on a podcast that's going live in about a week in Australia, and you'll obviously be able to jump onto it as well. Tell me, you've actually discovered a couple of pretty interesting ore bodies over the years. Cosmos was one of them. Sometimes it's all about timing, and lithium 20 years ago, not a lot of interest, was there? What did you discover? What did you stumble across 20 years ago but didn't realise that it might have a little bit of money behind it? Tell us all.
Yeah, so it would have been back in about 1997. Myself and another geologist, Terry Grammer, were the 2 exploration geologists for a company called Jubilee Mines, and we were drilling for gold in Kathleen Valley, and we didn't find much in the way of gold, but we certainly drilled through a heck of a lot of pegmatites, which contained a lot of lithium, but in those days no one was looking for lithium. Well, those same pegmatites are now the deposit that Liontown have got, 150 million tonnes of resources with a $5 billion takeover and the offer from Albemarle. So yes, we drilled those 25 years ago, and the timing was all wrong at that stage. But we did move on from that and then find the Cosmos nickel deposits, and those nickel mines are still operating today.
Pretty reasonable, but timing is so important, isn't it? So let's hope this one lines up for you, because it would be fantastic. You deserve it. Tony, thank you so much. Thanks for being part of today. Would you put your hands together for Tony Rivera, everyone? Right, I've got room for 5 panellists, and I've got room for 1 fantastic chair. Would you gentlemen like to come and join us up here, led by Scott Clement, who of course is from Tribeca, and I will hand over this microphone to him. And when we finish the panel, we're actually going to our lunch break. And if you're interested in lithium, not that I want to take away from Scott and the panel, we have got 2 lithium explorers who are about to get up on stage and present in auditorium 2. Scott, would you like this one here? It's been
Great. Well, thanks very much, Chrissy. And we're, I think, acutely aware of our position in the program between a hungry audience and lunch, so we'll try and make it interesting. I'm Scott Clements. I run Tribeca's office here in Singapore and our corporate advisory business. And thanks everyone for joining. And, thanks again to Stewie and the vertical events team for putting on a great show. We've had great feedback for it so far, and it looks like this will be a big annual event. So, and I think, it's good for Singapore, and it's great to see, so many different participants in the sector here today. So we're going to have 6 panels over the next 2 days, and we wanted to set it up that way because instead of just having a lot of company presentations, which are very interesting, no offense, Tony, it's a great company, Azure, and everyone else, but to mix it up a little bit and pick some subjects that we internally at Tribeca find interesting. And so this is the first one today. We'll have 3 today and 3 tomorrow. And so this one is about getting a very diverse group of investors on stage and just talking about how they think about investing in energy transition or decarbonization or electrification or whatever label you want to put on it from their organizational perspective, which are all quite different. And we see it a lot. People can get their heads around this theme pretty easily. You read about it in the papers every day. You see a lot of government activity supporting it in different countries around the world. So I think people are on board, but being on board and knowing how to invest profitably, those are two pretty different things. And it's such a vast theme. There's no right or wrong answers. So, thanks everyone for joining. What I'll do, I'll just quickly introduce everyone. To my immediate left, we have Sadiq Kernboy from Vulpes Investment Management. They're a family office based here in Singapore. And he'll be giving us the family office perspective. We have Amelin Wong, Head of Asset Management at Swiss Age Capital here in Singapore. And Amelin's been investing in resources for years from here, and I think has seen how the resource sector has been tracking energy transition as a new aspect of that theme. Next, we have David Aylward, the founder of Tribeca 25 years ago. It's amazing he still looks so young and handsome, but David's going to give us the Australian perspective, which was a key supplier of raw materials during China's industrialization, and will no doubt also be that in this energy transition. But also, there's a lot of effort in building downstream capabilities and renewable energy in Australia. Then we have Anthony Z. Anthony's the operating partner at Franklin Templeton's private equity business. Based in Hong Kong, Hong Kong and airline lounges, he travels a lot, and former CEO of Galaxy Resources, which was one of the early movers in the lithium space last cycle. So Anthony's one of the smartest guys I know on battery materials and battery technology. And then last but not least, Mayank Maheshwari from Morgan Stanley. He's on the research side, looking at energy transition in Southeast Asia. And so he'll be giving us a perspective on what Morgan Stanley's institutional clients are thinking about in terms of investing in this part of the world. So maybe I'll just start going around the group and get everyone to briefly go through how they organizationally think about investing in this theme and where they see the key opportunities. So Sadiq, maybe you could start. We'll just go down the line.
Sure. Thanks a lot. Thanks a lot. Hi, everyone. So Vulpes is a family office-backed asset management firm. So within Vulpes, there's a venture capital arm as well. There's a life sciences arm. There's also listed equities and also private equities, and also some new divisions around sustainability. So the way we think about sustainability is really much more, because it's a family, it's much more longer term in nature. So if you think about the average CEO is under 7 years. I have a lot of friends of mine who are in asset management and institutional management, where sometimes I had a CEO friend of mine tell me he's assessed on a weekly basis. And it's very difficult to think about a long-term theme of decarbonization when you're assessed at a very short-term performance basis. So we feel as a family office, we can take and think about it in longer term basis. And so, for example, as I was saying earlier on, we don't really use ESG scores because what we care about is the resilience of the portfolio. Our founder, Steve Diggle, some of those assets will go to his kids, which is 10 years down the line. And a score is not going to really help us a lot. So we spend a lot of time understanding really the asset as much as we can, and understand the idiosyncratic risk as well as the opportunity that the asset allows us to do. So the first thing I'd sort of say is that we think about things in longer term ways, and we try to introduce resilience into it. And which, as you know, with climate change, physical risks can be quite a big question to address. The second thing is really kind of a learning aspect. So I kind of joined about 1.5 years ago. And one of the ways that I kind of realized is that as a generalist, I guess I'm kind of getting useless. Because when you start to look and work with industry specialists, you understand how each transition for each industry is different. There's some similarities, there's some commonalities. But the interesting element is that each industry has different pressure points about how decisions are made or not made. And so one of the aspects, one of the guys that I work with is a real estate portfolio manager. So he really understands why real estate will or will not decarbonize or become more energy efficient. Now, since all of us are in Singapore, you kind of know that Singapore's emissions are more than 50% industry, and we all know industry is very hard to decarbonize. 15, 20%, like everywhere else, is transportation. So we can have all our Teslas and our batteries, which these guys know more about than I will ever know in my life, amazingly. And the other part of it is buildings. So if Singapore really wants to decarbonize and reduce its emissions, we have to really start to decarbonize buildings. And so with Solon, who is the real estate portfolio manager, who's been doing it for 20 years, we kind of set up a company called Green Hedgehog. And what we do is that we basically go into buildings and we basically make them energy efficient, reduce their emissions. We can do so by more than 50% in some cases. And we combine both our capacity to understand how these work from an engineering perspective, as well as on a financing perspective, and we'll fund it 100%. So actually we make returns there, but we also create an environment in which the building is more efficient and hopefully a step towards net zero, which is what will be the next trade that we do with these guys. So we think about decarbonization in multiple verticals.
Yeah, thanks. And thinking about it within the existing skill set of your organization, I think that's a pretty important point for a lot of family offices, or you need to outsource if you don't have that skill set. Emmeline, how do you guys think about it?
Okay, hi everyone. We look at the energy transition and play that thematic through the underlying metals that are needed to get to net zero. So primarily we look at the metals such as copper, nickel, lithium, and uranium. So we're looking at grid stability, energy security, and decarbonization thematic, battery metals, wind and solar as renewable energies. This is going to be a very intensively metal intensive period that we're in. And how we look at it, we run a variety of investment mandates with different risk parameters. So depending on the risk parameters, for more risk averse clients, we look at explorers, miners, so all the way from advanced exploration companies to development companies to production companies. So these are cash flowing companies. And for our more risk averse mandates, we only look to invest in the cash flowing companies. And, you know, how do we fine tune those investments? These are tier one companies. Corporate governance for us is key. Good balance sheet strength, good margins, and high free cash flow yields. Now, for those investment mandates that like to take on a bit more risk, we run what we call a barbell strategy. So not only do we have cash flowing companies, but we introduce sort of advanced exploration companies, and we only focus on tier one deposits. So these are the deposits that sit in the right jurisdictions, because political risk really is an issue for us. And they have the ability to be bought out eventually by the majors if they don't have their own development capability to do so. And I can't overemphasize corporate governance, especially from a junior mining perspective, because these are the guys that are in the driving seat to take the asset from exploration to cash flow. And in the mining world, sort of a rule of thumb we always work with is that from first drill hole in the ground to first cash flow, we're talking really about 10 to 12 years. So that's a long, long time.
Yeah, thank you. David?
Thanks, Scott. So from our perspective, so Tribeca is a generalist investor. We invest in lots of sectors. We have a large natural resources business, and that's important in this space, but we've, I guess, had to come at this space kind of looking holistically across industries and, you know, both sort of services and kind of widgets. And I think going back sort of over a decade, we're looking at that from the lens of, you know, consumers are the ultimate, you know, drivers of all the cash flows that we invest in. Consumers are telling So I think that they want kind of less CO2 in the world, less waste in the world, and probably less disadvantage in the world. And I think as corporates interact with that, I think we were sort of early days looking at that as kind of risk, lots of sort of hand wringing and trying to sort of think, well, are the businesses, are the cash flows that I'm investing in, are they at risk here for being kind of eaten away from this thematic? And then through a lot of sort of thinking about this, probably about a decade ago, 7 or 8 years ago, we really started to turn that on its head and think about trying to just really focus on the opportunities, because as you chase through each one of these problems, there are a bazillion problems that need to be solved to kind of get us there. And in those, the solution to those problems are materials, technologies, opportunities to make money out of. And I think the way we've tried to reflect that is probably the kind of cutting edge of that is our 2050 fund that we run, and it's the sort of the leading edge of the thinking there and investing purely across that thematic. But across everything that we do, we want these opportunities to be feeding through and also using that to test the kind of incumbents in various industries as to whether they are able to sustain the positions that they've got in their industry in the context of a world that's changing in the way that we're all talking about. So I think that's kind of broadly how we've framed it. Then I think because we've got a large natural resources business, we've tended to come at it from the upstream, and some sort of early investments. That's where I met the chap next to me, and some years ago. And I think over the next few years that will, we will be very active and we'll stay very active in that part of the market. But I think as sort of downstream into enabling technologies, enabling the picks and shovels and the tools and the systems that are going to enable all these thousands and thousands of solutions will be great opportunities for us to invest in. So kind of philosophically, that's how I see it. Just quickly, technically, that kind of brings us to a couple of issues. One, probably echoing some of the comments just made. We've tended to come in investing at a fairly sort of quality/institutional kind of framework, and a lot of what we're talking about here is development. So it's necessarily probably earlier stage than what we have historically been used to investors. So technically, we're having to come to terms with, build new partnerships, work out ways that we can maybe deploy capital a little earlier in the development of a project, with not wanting to let too much of that opportunity slide by, but at the same time not changing too much the risk profile that we offer our ultimate investors. And I think the solution to that, a lot of that is in partnerships, is finding great folks to work with that can fill in some of the knowledge gaps that we probably didn't have to worry about because we're only getting involved in things in that sort of later stage cash generative sort of phase. So that's one thing. And I think the other one is the duration of investment. So more and more of our time is spent trying to bring our customers with, our investors with us on a journey to invest, to be more long-term thinking in the way they invest, so that our capital can become more patient, because this is going to take a period of time. It will be volatile on the way through. And I think the best gains are going to be made for those that can have the most patient capital. So I think that's kind of how we're seeing it.
Yeah, thanks, David. Anthony?
Thanks, Scott. So I'm an operating partner with a global private equity group at Franklin Templeton. And for probably many of you will probably know Franklin Templeton more as a public equities or mutual fund house, and probably less aware that we actually do have a fairly substantial alternatives business. So obviously Franklin is a very large group, manages about $1.5 trillion AUM. But out of that, about $250 billion of that is within the alternatives, and global private equity sits within that group. To share with you probably some perspectives in terms of, I guess, some of the decarbonization strategies that the firm has pursued. Probably worth kind of just rewinding a little bit and to share with you some perspectives that I've garnered over my 12, 13 years in the industry. As Scott mentioned, I was a former CEO and MD of Galaxy Resources, and essentially stayed on until the merger with Orocobre, where essentially I oversaw the growth of Galaxy from a junior developer. We were the second producer of lithium out of Australia about 11, 12 years ago, and essentially over the past 12, 13 years have seen it grow into becoming the world's 5th largest lithium producer. So really managing operations in Australia, China, Argentina, and Canada, and initially servicing most of the strategic customers in China, Japan, and Korea, and then in more recent years in Europe and US as well. But as part of that journey, what I really saw was a lot of growth coming out of North Asia, specifically China. Initially, myself personally ended up becoming quite active as a venture investor in other opportunities outside of Asia. Within the battery value chain, I was an early investor and a shareholder, and went on the board of a company called Li-Cycle. Today, Li-Cycle listed on the New York Stock Exchange about a year and a half ago, raised about $600 million and then $350 million subsequently through investments from LG, Glencore, and Koch Strategic Partners. We're recently awarded $375 million from the Department of Energy through the Loans Program Office, and really have built Li-Cycle to become North America's largest lithium battery recycler. And they're also building capacity in Europe. Along the way, I also was a seed investor and was a board director of a company called Li-Metal, really looking to produce lithium metal and develop lithium metal anodes for next generation solid state batteries, as well as a seed investor in a company called Sakona, which is developing next generation silicon carbon composite based anodes for, again, next generation batteries. And so it was in the backdrop of that when I stepped back from my corporate roles about a year or so ago, I got asked by Franklin Templeton to come along and really help the group devise a strategy and investment thesis around essentially a climate tech investment strategy, but really focused on decarbonization. And when we looked at decarbonization, obviously transportation and the utility sector were the two kind of biggest generators of CO2 and greenhouse gas emissions. And so zooming in on that, what were the potential strategies that could help the world decarbonize? And obviously electric mobility, renewable and storage was a key focal point. And within that, the battery train, and specifically the lithium ion battery train, which I have become quite familiar with over the past 12 to 18 years, has ended up being quite a big focal point. So essentially really looking at the battery value chain all the way from, I would say, midstream, from chemical refining through to materials, to cell manufacturing, whether current generation or next generation kind of batteries, mobility, storage, as well as obviously recycling, which is increasingly becoming an important sustainability focal point for critical materials. Today, we've launched a climate tech strategy, and we actually closed our first transaction last year in the space, which was we co-led a $150 million round into an LFP cell manufacturer based in the US. Obviously, many of you would have heard not only what's happening on the IRA front in North America, but also on the CRMA front in Europe. Obviously, there's a lot of capacity and a lot of opportunities to basically deploy capital in the burgeoning growth sector. There's a lot of catch up that the rest of the world needs to play. And it's not just isolated to the US, North America, and Europe. I'm very excited by what's happening within the battery value chain space across Southeast Asia, from India through to Malaysia, Indonesia, Vietnam, and Thailand are all hotspots for building out that value chain. So, really that's kind of the main focal point, is looking at how to support some of this growth. And there's a lot of capital that's going to be needed. I mean, Joe pointed out, earlier today that we're probably going to need somewhere between another, 3 to 3.5 million tons of lithium to come out of the ground. I mean, the capital intensity of lithium projects now have actually increased since the time that I first started, when, the average brine project would be somewhere between $12,000 to $15,000 a ton. Today, they're probably north of 30 on average per ton of LCE. There's some projects in Australia which are probably a little bit more expensive. And in the US as well, $50,000-$60,000 per ton. So, if our average today is about $30,000 to $40,000 a ton, just on lithium alone, it's going to require somewhere between $100 to $120 billion of investments. And then when you start looking at other parts of the value chain, such as cathode and anode, they respectively add another couple of $100 billion themselves. And then you've got recycling as well as other parts of the materials value chain, for example, precursor, substrates, copper foils, aluminum foils, electrolyte salts, binders, etc. So all of these components are necessary in order to really build up the supply chain. And I think, Scott, later today, we're going to have some debates around kind of, China versus, what's the dynamic of world and global growth compared to how China's come so far. And basically that's kind of one of the main focal points for Franklin Templeton, is really looking to support and deploy capital to support value chain and supply chain growth in parts of the world outside of North Asia, where it's already quite mature in China, Korea, and Japan.
Yeah, thanks, Anthony. Mayank, you're the only sell side guy here, so it's wide open for you to say whatever you want. So.
Thanks, Scott. So let me just put some things in perspective for the audience first before I kind of deep dive in your question. So if you look at today, correct, in terms of global energy consumption, if you want to put some exajoule numbers, about 80-85% in that range comes from what you call as fossil fuels, whether it's coal, gas, or oil. About 11% comes from hydroelectric or nuclear. And then you are ended up with the 6%, which is largely coming in from renewable resources right now. So when you put this in that bigger picture context in terms of energy consumed today, the opportunity size on energy transition is pretty reasonably big, correct? That's the way we kind of think about it from our perspective. Now, in terms of the question that Scott was asking of what investors have been thinking, I think the biggest debate that we have seen really has been around energy security versus energy transition. That's really a place where a lot of incremental institutional questions keep on coming now, especially after 2022. And the way we look at thinking about this is that the both of them will coexist and move hand in hand. Yeah. And the way to kind of think about this over the next few years is that a lot of these companies, which are especially in the fossil fuel side today, they are actually investing in terms of the new energy side as well. So those are companies that effectively are championing some of these transitions as such. I think the other part of it is the fact that you are seeing the entire value chain from just not producing green electrons, but going down towards the entire value chain into green hydrogen, ammonia, etc. And the shift in supply chains from not just one country, but going to other countries as well. So those are places, I suppose, from where we come from, we see opportunities exist. Scott.
Yeah, thanks, Mayank. We're probably going to go over time, but no one's telling me we can't, so we'll keep going. I just wanted to ask everyone a different question following on from the initial comments. And Amelin, maybe I'll start with you. If you go next door and talk to every mining company over there, I guarantee you 100% of them will tell you that there's going to be a massive supply shortage in their given commodity over the next few years. So we're used to that as resource investors, but we're also hearing independent voices saying the same things that don't come from the sector. And so I think that's the big question. Do you think there really is these massive medium to long-term supply shortages, and given the amount of capital that it takes to develop new copper mines, et cetera, how do you guys think about the solution to that if it is the case?
Thanks, Scott. Well, as we stand now, there is definitely a big demand-supply mismatch. And we've been pounding the table for a long time now saying there is simply no supply of key commodities because simply we haven't been putting enough capital to work to do exploration. Now, in the natural resources game, it's not you just throw a lot of money at it and you will get the solution tomorrow. As I alluded to before, it takes a very, very long time from your first drill hole and going through various rounds of exploration programs. You have to prove up an economic deposit. There's the issue of permitting. There's the issue of getting capital to fund the project. And you're talking about geopolitical risks and all that. And you're talking about years. I was talking to a head geologist the other day, and he says that cycle from first drill hole to production has actually widened from 10 years previously to up to 15 years. And you've got a lot of jurisdictions now that, frankly, in this cycle, they're a lot more risky than in the previous commodity cycles. So we've actually only got a very small country window of where we are comfortable to invest in. So supply is a big issue. Now, every day you see plastered in the newspapers, we want to be at net zero by 2030. We want to get rid of ICEs or petrol consuming cars by 2035. A lot of arm waving on the political front. There is an acknowledgement now, you've seen with the IRA out of the US, Canada, Europe, slowly coming to the party, acknowledging that we need to transition quickly. But the reality is we're not going to meet those timelines. We need actually incentive pricing for supply, more supply to come to the market. At the end of the day, price is a factor. So we either need to dampen demand or we need to increase supply. There's no two ways around it. So what can happen in the meantime? Time period, look, at the end of the day, market's clear at a given price. In the meantime, we have evolving technologies, okay? We can become more efficient. So there's a bit of an element of substitution. But what I can guarantee you is that, probably push the timelines in making our way to net zero. You already see countries like Germany pushing back on, getting rid completely of the cars that we know today and possibly incorporating green fuel. Various nuances to this theme. At the end of the day, from the policymakers' point of view, we need to permit projects faster. I mean, in the context of Canada, it takes 5 years at least to permit a project, right? That's after you've proven up the deposits economic. And then when you do the permitting, after that, you've got to get the capital. So it just goes on and on and on. So it is a real problem. So I expect to see technological advancements, substitution effect, and I expect to see glory days for M&A activity in the sector, because when companies, or the bigger companies, bigger end of the spectrum, they decide to spend again, they are going to be spending on buying growth.
Yeah, thanks. And maybe following on from that, Anthony, there's a keen focus around the world of decentralizing supply chains out of China. And yet we're still seeing, CATL doing joint ventures in the US with Ford and Tesla. There are a lot of commodities where the Chinese have a great head start that, may be insurmountable, especially in the downstream. But do you think it's realistic for Western countries to truly diversify their supply chains out of China, or is there just going to have to be some kind of pragmatic accommodation ultimately?
First and foremost, I don't necessarily subscribe to the view that you can decouple your supply chain from China. Depending on which part of the supply chain you're looking at, between lithium, nickel, and cobalt refining, you're looking at anywhere between 60 to 80% concentration of global capacity sitting in China today. If you're looking at cell manufacturing and EV manufacturing, it sits between 70 to 75%. If you're looking at other critical materials such as cathode and anode, cathode is 95% concentrated in China and anode is 98, 99% concentrated in China. And I often get asked by kind of Western strategics and also kind of Western institutions, well, how come, China has come so far? And the main reason is because they started early. They started about 15, 20 years ago with the first iteration of the 5-year plan, and it's taken them 5 versions of the 5-year plan to get to where they are today. But what's also important to note, apart from the concentration of capacity there, is that there's also a concentration of know-how. So much of the technical expertise to refine lithium, to convert lithium, to refine nickel, cobalt, to make cathode, to make anode, to make cells, to make next generation cells, next generation materials. The biggest electrolyte producer is a Chinese company. Biggest nickel cobalt precursor manufacturer, CNGR, again, is a Chinese company. So a lot of that know-how, or from the investor perspective, a lot of that de-risking is also sitting with Chinese companies today. Now, in a post-COVID situation, even if we took away the whole geopolitical debate for a moment, the world has finally woken up and realized that maybe the last 20 years of globalization did not necessarily have its desired effect in terms of kind of the leveling out of, or the distribution of economic wealth through different industries around the world. Secondly, post-COVID, many countries around the world and many regions around the world are so much more sensitive, acutely aware to the fragility and the resilience or lack thereof of supply chains, whether it's lithium, nickel, cobalt, or PPE, or masks, or pharmaceuticals. In a post-COVID situation, that problem or that issue has only been further exacerbated. The second thing is that if you actually think about building out more stronger regional resiliency, it actually helps towards decarbonization. And the main reason is because if we think about globalized supply chains, they also mean that materials and components have to travel a long way. And the anecdote that I would share with everyone is my Tesla. So I'm a first generation Tesla owner. I spend most of my time, I live in Hong Kong. And when I first bought my Tesla, the lithium inside that Tesla started off life in Argentina. It was actually produced on the Salar de Hombre Muerto in Argentina by Livent. Livent then shipped that lithium raw material to North Carolina, where they converted it into lithium hydroxide. That lithium hydroxide then got sent over to, as Joe said earlier, Shikoku Island, where Sumitomo Metals and Mining converted it into an NCA cathode. That cathode then got sent to Osaka, where Panasonic converted it and made it into a cell. That cylindrical cell then got sent back to the US, to Nevada, where Tesla assembled it into a battery pack. That battery pack then got trucked back to California to get installed into a car. And then guess what? The car gets shipped all the way back to me in Hong Kong. So if you think about just one unit of material inside that vehicle, it's probably done a few tens of thousand air miles or boat miles, whatever you call it. So actually, we get a double whammy by looking towards strengthening regional supply chains, because by strengthening the supply chains, you're actually also shrinking your overall supply chain distances that materials have to travel. And by shrinking those distances, you actually achieve another level of decarbonization. So yes, I do think it's important to actually build a resiliency, but also you need to build a resiliency off the back of, investors will only deploy capital once the project's been sufficiently de-risked. So how do you de-risk it? Well, one of the other challenges that we talk about not so often in our industry is not the lack of capital. I mean, there is a lack of capital. Hamlin pointed out that we haven't been investing enough into pipeline development projects, whether it's lithium, nickel, cobalt, or other critical materials. But the critical factor, apart from the permitting, is actually the limited availability of human capital. So when I started in the industry, we only had 5 or 6 producing lithium projects globally, okay? And the rate at which we need to grow lithium supply now is we need to add somewhere between 12 to 15 lithium projects every single year between now to 2030 to actually meet demand supply balance. And the other challenge that we face is that there simply isn't enough kind of, how can I say, technical expertise to develop these projects. Who've actually taken the project from developmental stage, exploration, through feasibility, through construction, commissioning, operating, and then ramp up. And therein lies not only the challenge, but also the opportunity. David talked about earlier about partnerships. And I think partnerships are going to be the way to go. Obviously, we've seen the likes of CATL move into Europe. I was just in Hungary last week. They're building 100 gigawatt hours in Hungary between now and 2030. SK, Samsung SDI are in Hungary as well. And so if you didn't have the Chinese players or the Korean players landing in Europe or in North America, you would have an even more remote chance of standing up that capacity. So yes, I think we'll see more capacity. Yes, I think you'll see more diversity, but you'll also see more partnerships in helping de-risk some of that capacity standing up. And where does that expertise and that de-risking come from? It's probably going to be coming from Asia.
Yeah, thanks. Chrissy came in and gave me a fierce look, so we're over time. But maybe just one quick last question for the panel. We'll wrap up. And Sadiq, maybe I'll let you have the last word. As a family office, we often have, well, I mean, we're not a family office, but we talk about it as a fund, but I think it's more acute as a family office. You think about this issue of, should you be sacrificing profits as an investor to do good, and how do you mix philanthropy and investment and, and I think again, particularly acute for family offices that often, there's no set mandate and you have new generations coming up that are probably more focused on that than the older generation. So how do you think about that as a family office investor?
Look, I think that is the core challenge. So I think increasingly we find that the trade-off is not really there. So for example, in the green hedgehog business, we're able to generate returns and also decarbonize at the same time. But there is an element of it which is an upside for the building owner, which is not priced in. So for example, in Australia and the UK, there's a lot of good evidence that there actually is a green premium. So green buildings are more expensive than not so green buildings. That premium in Singapore is very, very small. So one of the positives is that if you actually go ahead and decarbonize down the line, it could actually mean a higher return. So in thinking about investments, we have to think about what could happen. And you and I have talked about, for example, the carbon markets and some of our frustrations about how long it takes, but you need to have a price of carbon that is visible in order to be able to crystallize some of this value. But I should also say that it is not just about carbon. So for some of you, I guess none of these people here talk about palm oil, but amazingly, there is now a premium for the most sustainable palm oil compared to the less sustainable palm oil. That was not there a few years ago. So the market is beginning to price some things today that maybe it didn't do so 5 years from now. So when we think about investments, is what is going to be priced in the next 5 or 10 years. The more you can measure it, the more you can monitor it and verify it, because that's also becoming very, very important. The more we think some of those things will get priced in, but not all of it is. There's a couple of more things I want to sort of say. One is that on governance, that is our most important thing. We spend all our time on governance. When you kind of, people don't like complexity. Doing a lot of these things is a very complex process. There's going to be unintended consequences. And we could talk about many examples where we've seen assets where you're trying to do good, but you actually end up creating something very, very negative, including one where they tried to protect some trees, but they found out that the trees were being cut by the village to pay for school fees. So actually you denied school fees. So you've got to look at it in a much more holistic way. I think it's a word that's popped up a couple of times. And governance is critical. It's not just about the ability to actually build plants. Amazingly, it's about whether management even understands how all of this translates into a dollar and a cent. Sometimes I think the sustainability officer should report to the CFO because it kind of forces the CFO to actually put a monetary value on what is actually going on. But I want to sort of end with one more little thing. On the family office side, and in the past, as you know, there'll be philanthropy capital, right? So you kind of like, you do maximize profits, and then you take some of that and you put it into philanthropy capital. That's starting to change. So even in Asia, we're starting to see the rise of what we would call catalytic capital. So this is capital that will try to look at new projects in certain areas where you look at both the financial return and some other social return or something else. And it could be anything. It could be anything from women empowerment. It could be even decarbonization and microgrids. And what you try to do is that you try to put these positions in place to see if it works. And if it works, then you scale it for a commercial purpose. So it's not just like philanthropy, it's now switching to what we call catalytic capital. And going back to your original question, yeah, for us, the challenge is just that. Challenge is this is a capitalist problem. I think what you're trying to do here is try to find a capitalist solution to a capitalist problem. And that's the challenge I think we're all trying to solve here. If you can do that, more capital will come in.
Yeah, absolutely. Well, sorry we had to cut it short, Mayank and David, but David said anyone who came up to him later, he'd give them his top small cap stock pick. So feel free to do that. But anyway, thanks very much to the panel and thanks everyone for staying. Thank you.
Tim, I'll let you all go. We're coming back in here at 1:20. There's plenty of lunch, so please don't feel like you have to rush. Stewie has over-catered to the tea as he always does, so please do not panic that you won't get any lunch. There'll be plenty of opportunity and you can bring it back in here. We have our next panel session at 3 o'clock. Did you enjoy that? Yes, lots of insights. Give them a big round of applause. It's a very interesting. And it's a problem when there's 6 of us to try and fit it all in. So we're going to take one step forward and get a picture. That's all right.